we can go through a few exercises in chapter 14 that hopefully my goal is it might give you some more detailed ways to think about the cash flow group project assignment. And so I'm going to go through these, but then also after this, I'm going to pull up a cash flow from uh, annual, whatever that website that you pulled yours, annualreport.com, and we'll just discuss it. We'll discuss those questions that you're being asked to write the report on, and we'll just see where the discussion leads. So first, the exercise, it's exercise 14.5, and for A, it said prepare an income statement for the year in a multiple step format. I actually just provided the answer right here. Because I think the main things I want you to see is actually in B and C on this exercise. So using this this net income, how it's formatted on this spreadsheet. So if you notice in the textbook, it just gives line items. It didn't format it in this way, in this multiple step format. Multiple step format is like you're calculating the gross profit. The data given in the exercise 14.5 did not have it formatted that way. And then it has operating income and then these non-operating. I think you, Marcia, you might have asked about non-operating income. Here's two line items, like interest revenue, income tax expense. It's these items that are not normally normal for the operations of a business. Those are two examples. Okay, so taking this format, let's calculate gross. If you go to B, you'll see it says compute the gross profit rate. Okay. So to calculate that, you're going to need your gross profit. And then, yeah, net sales. Yeah. This is not really formatting the right way. So here, I'll just do it. Do it over here. Questions? Y'all got it? Net income as a percentage of sale. I don't know why they have all these dot things. Alright, that is net income divided by net sales. Yep. Okay, 9%, 8.65. Round up to 8.7%. Return on asset, next one. You take the operating income and divide that by the average total assets. Operating income, 569. Did it give that number for average? It gave that info. You see it in the textbook. It said average total assets is 2.575 million. Okay, return on equity, taking the net income divided by the average equity. Net income, 380, 379. And then it gave the average equity total and the problem. %19.8%. Sorry. Okay, yeah. Know how to do those calculations. I think it might be helpful. Maybe it might be in the quiz also. All right, let's move to exercise 14.6. Okay, shown are selected data from the 2015 annual report of CVS Health, a large drugstore chain. So we got total assets, total stockholder equity, operating income, and net income. And then it's separated into beginning of year and end of year. In A, it says compute return on average total assets. So that is what we are calculating here. Return on assets.
Add the two together.
Yep, yep. So the top is going to be operating income. And then divided by average total assets. Okay, so the top should be 9454. Then yeah, you're at 70. So you add the beginning year and end of year and divide by 2. 74,187 plus 93,657 divided by 2. Was that? Okay. All right, that should be the answer. 11.27. Turn on equity. The top is going to be net income divided by average total stockholder equity. So the average total stock equity. So net income was what? 5239. And then average stockholder equity. The beginning is 37,963 plus the ending of 37,203 divided by 2. Take the net income divided by average stockholder equity should be 13.94%. All right, so C, I think, is a good question to ask. What is most likely the explanation why CVS Health stockholder equity for the year decreased? Any idea? The assets increased. So if assets increased, would that so
Oh,
I don't-
liabilities. Assets equals liabilities.
plus owner equity. So actually, if assets increase, I don't know if that would be a reason why stockholder equity would decrease. Because if assets increase and you didn't pay debt on it, then you would think equity would actually increase also. What affects the equity section of the balance sheet? So stock, like if you're issuing stock or a dividend, or the retained earnings. So most of the time, if stockholder equity decreased, most of the time, if there's nothing, you didn't see like any line item for dividend, then nearly all the time it's because of a net loss. Net loss, decrease in retained earning. But in this case, it was net income. There's actually net income, so I don't know if that would. I don't think. I mean, I would expect the net loss would decrease. Yeah. So we don't have any other information. So I would assume. I don't know if it would be for a net loss, right? Because it said here was net income. So it could be for one other thing I forgot to say is treasury stock. Like they could have bought back stock or they issued a dividend. So that'd be my educated guess. That's what the solution says too. So. All right, let's move on to 14. Exercise 14.7. Actually, I'm going to skip it. I'm going to skip that one. We're going to go to We need to go to exercise 14.11.
So it's gross profit percentage, the gross profit rate.
Yep. So what is it asking for both years? So it wants us to calculate for year 1 and then year 2.
So you gotta calculate the gross profit first.
Yep. Yep.
And
You are
then-
correct. So to calculate gross profit,
So it's minus 45.
I mean, gross profit divided by the sales. That's what the formula is. Like this merge. Okay, so in this example, year 1, the gross profit would be
610.
minus cost of goods sold, which is what, 408. And then divide that by sales of 610,000. %. All right, let's do it for year 2. Sales for year 2 is 750,000. Cost of goods sold 495,000. Divided by the sales of 750,000. So 34%. Okay. The next ratio it wants is inventory turnover. Cost of goods sold divided by average inventory. So year 1. Eight, 3 by 102. Okay, year 2, cost of goods sold is how much? 495 divided by average 110. So what that's saying is inventory, turned over 4 times year 1. So they had, well, depending on their accounts receivable, if they had an AR, then if they collected AR rather quickly, had no AR, they would have 4 operating cycles. But they had at least 4 cycles of inventory going out the door. Okay, accounts receivable turnover, year 1. Okay. This is going to be sales divided by average receivables. Year one sales 610,000. Average receivables 100,000. Year two 750,000 sales divided by 150,000 average receivables.
Yeah, it's just, that is the next question. I said, which one's better?
Is that what B is asking us for? Let's see.
Comment on favorable and unfavorable trends.
Yeah. So let's talk about that. Any thoughts? Yes, that's a positive favorable trend. Yes. Inventory.
Receivable is decreasing, so
Yep.
it's taking longer to collect.
No, that's a good thing. That's like a shorter, so that's actually a favorable result. So it's so both. Well, the inventory turnover, accounts receivable turnover are trending in a favorable way. Gross profit percent. I mean, it's trending 1%. It's a favorable. Let's see if there's anything else it mentions here. Yeah, I mean, the solution, it talked about the inventory turnover increasing, indicating the company has increased its sales without having to proportionately increase its investment in inventories.
Oh, so inventory cost went up 8,000, but they profited where the sales went up.
Yeah, I like that. I like that thought.
Spend 8,000.
Yeah. Yeah, I think that's enough thought on this one. We can move on to let's see here. Yeah, so I post these solutions. Um, the only thing I'm not gonna post, you gotta remember to take this solution out, is the comprehensive problem that's in chapter 14 that's due um, next week. But I would encourage you to get more practice. Like if you want more practice, um, then look up some more of these exercises and then look at the solutions, and you could do some self-reviewing, self-studying that way. I just want to go through a couple of those to kind of get you going. Let's talk about let's pull up the questions for that group assignment, and then I'm going to pull up a cash flow statement from a company. And then let's just discuss these questions that you're supposed to be writing about. So one thing to clarify, question 7 and 8 on this is actually not necessarily, you might not be necessarily getting answers from your two companies you picked about what type of company may have negative net cash provided from operating activities, and what type of company may have large positive net cash provided from operating activities. If you did choose a company that does answer those, then go ahead and write about it. But those two questions is just making you want to think in general about what type of companies would have the negative net cash provided from operating activities.
They're long operating. Yeah.
So if I remember right, you guys picked a healthcare. Yeah, so I went and found the financials for Boston Scientific, which I think is a competitor of the two you guys picked. So let's go find the cash flow statement. Of course, So I just noticed on this one, like it did have a section for like this is not even the cash flow statement, but it had like a table or a schedule of information that you probably would have got off your cash flow statement, and it looks like they did even a write-up on operating activities, investing activities, and financing activities. So not sure if you guys I had that in any of your other reports as well. Yeah, so sometimes the auditors who are doing the financial reports for these companies, they do provide some verbiage, and so obviously that would be.
They actually had the current ratio listed, I think, in the Medtronic one. One of the pages, I was like, whoa, current ratio.
Yeah, yeah. But for this purpose, I'm going to actually go find the cash flow statement and analyze the cash flow statement. So bear with me. I didn't look what page it was on. What is this? This is an income statement. So I think we're getting close. Balance sheet. Okay, here we go. Can you guys read it? Okay. All right. What information can we gather about cash from the operating?
Provided by operating activities.
That would be all in this section right here. I mean, the first. So their net income, it did increase from 17 to 18.
The increase
Yeah. Yeah, let's go through and see and analyze from 17 to 18 and just go line by line here. So obviously this would be something to research, like what caused the net sales, or I'm sorry, net income to increase. So I'm going to jot down some things that we should probably look up and research. So net sales. Yeah, I don't feel like talking about that line. I'm going to skip that one. Let's maybe we might engage in a conversation on this net loss gain. This one, this accounts payable line item. And other liabilities was another one. All right, so let's this.
So when they write net loss and then gain is in parentheses. So the word gain. So does that mean the 155 is a gain? It's increasing the loss. The loss.
So you have net income, and then they're then they're subtracting out 155 from the net income.
Right. Yeah, because I think it's a net loss, but then it says it's a gain if it's in.
Yeah, yeah. So it's a gain that was included in net income, but it needs to be subtracted out because it's a non-cash income item that was in the net income. So let's talk about why that would be. So it could be a net gain on investment and note receivable. Okay. That's a fun one. Let's do this. Okay, so it was a gain. Let's assume maybe it was a gain on investments and note receivable. Let's just assume it. Let's just for this discussion, let's just assume it was an investment. I'm not sure what the investment is. I mean, we can maybe even do some research and see if they have a write-up on investments. Actually, what page? I don't want to leave my page here. On page 60. Actually, I'm not gonna actually look up the exact reason why, but like if they have it, they have investments like they could have investments like maybe even a mutual fund. You know, they could have deployed some of their cash into a mutual fund, and then they're just realizing the gain. But that gain is they didn't receive cash on it. It's just a gain they had to report. They could legally report a gain on that investment, but they didn't receive cash. It's a non-cash item for that particular situation. So that's why they're subtracting it out of net income, because they didn't receive cash for that gain. Yet they're but they're able to legally report it as a gain on the net income on the income statement. But for cash flow purposes, they didn't receive the cash for that gain.
It's not like
Because it's not like what?
liquid or whatever you were talking about.
Well, yeah, I mean, it was a gain that didn't produce, they haven't received cash on it for whatever reason. For
the notes receivable and they re-up their notes receivable at that the gain on there too, because they didn't actually get paid anything. There's something on
they could have sold, they could have divested part of their business. So like what I would probably, one thing that when I saw a note receivable, I would probably go research in the write-up of this report to see if they divested of any assets or even divested part of their company. And they didn't receive all the cash up front from whoever purchased it. They put it that they're still due money from whoever purchased that equipment or asset. I could totally have it totally wrong, like as far as what really happened, but that is an example of what could have happened. Is they sold something, they received part of the cash, and then they're waiting to, they self-finance the rest of it on a note. So, and that's why it's on a note receivable. And so that's why they had a gain on, that's actually a pretty good example. Let me think of a journal entry. So if they, let's say they sold, an asset for $1 million, you would credit that asset for 1 million. Let's say, and then let's say they got 500. Let's say they had, you know how assets have, you know how you depreciate the asset, so you have accumulated depreciation. So the basis they had in those assets after accumulated depreciation, let's just assume it was $500,000. So the gain they record on the books is $500,000 because the sales price was 1 million minus the adjusted basis for those assets of 500,000. So that's how they could report a gain. Let's say they received 250,000. So the sales price, let's say a sales price of, so I told you wrong. Let's just assume sales price of $1 million. Okay. Sales price, $1 million. So let's say they received cash at 500,000. And then they put on a note receivable for the other 500,000. So the basis that we're assuming of those assets is 500,000. So after accumulated depreciation, so really the asset that is being written off is a credit for 500,000. Then the remaining 500,000 is going to be credit to gain. Sales price million. We received cash of 500,000. Note receivable. 500,000. I mean, so like, let's say the asset, because on the books you probably had an asset of 1 million, so then you can take it over. So that's a credit. But the thing is, remember, you had accumulated depreciation. Accumulated depreciation normal balance is a credit, so to write it off the books, that 500,000, you would actually debit accumulated depreciation. And then what else are we missing to get a gain? Would be credit. 500,000. So do our debits and credits equal? So cash debit, note receivable debit for 500. That's $1 million. Asset, we credit, that washes out. Depreciation debit for 500,000. Gain for credit 500,000. And so the debits and credits zero out. That might be a way how they got a note receivable and a gain. So see how we got on that long tangent? Just talking about like how we subtract out a gain from the net income. And if you notice here, you see in this example, the only cash that this cash in this example was 500,000, but it is since they self-financed on, had a note receivable. This is a non-cash item, then that gain. That's what I was trying to say. The gain is they didn't necessarily receive cash for all that gain because 500,000 of it is received. So. All right, back to the cash flow statement. Okay, accounts payable and accrued expenses. This line, let's talk about that. So if it decreased by 631 million in 2018, does that mean accounts payable and accrued expenses increased or decreased from the prior year? They're subtracting 631 million from the net income. Yeah, so if they're subtracting that out, that means, sorry, what did you say? It increased, so you increase accounts payable. Yeah, you increase the accounts payable, which would decrease net income. $631 decrease net income. It would decrease because it's net expenses and net income.
How is the so then
Yeah, this is a harder one. Ah, yeah, it's getting late. Sorry, guys, who's listening to this recording. We're pressing on. Uh, net income. Okay, so net income was 1671. Yeah,
Are
go ahead.
you, like, subtracting all of those?
Yeah, if it has a if it had a negative 631, it's subtracting out accounts payable and accrued expenses from the from the net income.
So, you know, like in our cash flow statement, we had like add,
Yeah,
top section, then less.
right.
Next set of numbers.
Yeah.
So are we subtracting a negative amount? So it's actually positive?
We're subtracting out. This is a decrease in operating liabilities. So operating liabilities decreased. Yeah, did I just answer the question? So decrease in operating liabilities. So that means that accounts payable and accrued expenses decreased. So if accounts payable decreased, that means they paid off accounts payable. They paid off more account with their cash. Yeah. Does that make sense? So and then, so that means that, yeah, yeah. And you're subtracting that out from the net income because that's accounts payable that was paid for, like that was like one question might be, okay, why isn't that aren't those expenses already reflected in the net income amount? But the reason why you're subtracting out, a decrease in accounts payable is because the from the net income is because uh, you know those expenses were all recorded in the prior year net income amount, and so it's just now there. So that what this is telling me is there was either accounts payable or accrued expenses that had to be adjusted, that they paid, like, so they could potentially have uh, accrued a lot of expenses on account and they're just now like paying it off. So that might just be something to research. Um, uh, and then this other liability, the same thing. They are decreasing those other liabilities. I would definitely research that. Kind of curious what's going on. We are subject to a number of market, business, financial, legal, and regulatory risk and uncertain with respect to our international operation that could have material impact on our business, result on operations. I'm going to look at the balance sheet real quick. 1164.
Just calculate the cash flows from operation to the current liabilities. We've got 0.06. And it says that the cash rate should go up before the virus.
Yes.
0.25 in 2017.
What ratio did you calculate?
The cash flow from operations to current liabilities for Boston for 2018 is 0.058.
And so you interpret that to be weak.
Yeah.
Yeah, that's a really good thought. I'm trying to calculate the this change in other liability that went on the
The charts would be fine. Problem.
Yeah, I'm struggling. I was trying to calculate this, how they calculated the 1164 from the balance sheet items and other parts of the financial report. I think the main thing is this other liability. There was a something went on here with that other liability, like where you're having to subtract out 1.1 billion from the net income as a cash outflow. I guess what I'm trying to say is, like, if I'm reviewing this cash flow, I would be like,
Got sued or something?
right, we don't have time, I don't have enough time to go and read this entire report. However, if I was analyzing, since, that's the main thing is, like, hey, this popped out. I guarantee you, if you go read this report, it's going to be something in regards to litigation or something that happened.
2018 cash from operating activities decreased by 1.16 billion due to an IRS tax settlement.
Yep, that more likely is the result of what happened in this other liability, because they probably had to report that tax settlement, tax liability, true up, and other liability. That's what I would be putting in my report, like, these different things that we're talking about. That's like, that all would be answering this one question of what information can you gather about cash from operating activities. So all this stuff we discussed is what I'd be typing up in your report. So we only got, we spent like all this time and got some good data, I think, at least some good thoughts to go research, and just on this one question. You do that for, the investing. Let's give it a shot for the investing. We still have some time. Let's move to the investing activities. So what information can we gather from investing activities? I would kind of go through the same thing. It appears that purchase of property, plant, and equipment seems to be in line with prior years. Payment for acquisition of business. So that's the big thing that happened in 2018. And so I would find out what type of acquisition.
Top of 46.
Page 46, talk about the acquisition.
Cash used for investing activities including 1.44 billion. Payments net of cash required for acquisition, including Phoenix, Index, Dara, right here. So it's like 5 business.
So this is essentially what you want for like the three the operating, investing, and financing activities, right?
Yeah, you could find some information like this, and then yep, exactly. That's the type of information that would be useful in gathering.
So just try to find the big things that stand out.
Kind of the bigger things that explain it. Yeah, exactly. That stand out. Number 4, the question number 4, how do you describe each company's change in cash position during the year? What interpretation of the strength of the company's current end of year cash position? So like, are they being smart with their cash? You know, are they do they have too much cash on hand, like, and not using it for investment opportunities, like, you know, purchasing a company or other assets? Is there, you know, knowing the industry, like, is there opportunities in that industry that you chose that they could, you know, invest their cash into something for opportunities, or is there like threats that come upon that industry where they need to have maybe a certain amount of cash on hand, you know, to cover their payables, or, you know, if you know that they are in the middle of a lawsuit or IRS settlement, you know, are they going to need to keep, how are they going to finance, you know, that settlement, or how are they going to, it's always going to be a combination of using cash, but then also financing too, like from a bank, you know. So in your opinion, what's a good balance of a good cash position to keep the normal operations going for the business, for new investment opportunities, and then also combining, you know, finance from a bank or other investors as well, to keep things going, and also not only keep things going, but minimize risk, or like hedge, you know, just the you know, pay obligations that they're currently under, or also keep things going, or future opportunities that might come their way. Yeah, it is always helpful if you can find that page where it talks about the investing financing. That might be a little trick of maybe finding companies that have it. Yeah. But that was a good find there, Eric, on the investing information. Let's go back to the cash flow statement. So it looks like historically, the way I read this purchase of property, plant, and equipment, historically, you know, they're paying $316 million or so. Keep that in mind that, a lot of these, like, this is just one line item that historically they're needing that much new equipment or plant, and property, plant, and equipment to at least just maintain their current levels of sales. And so just know that they're always having to purchase these assets to continue to generate revenue. Payments for investment and acquisitions of certain technologies. Looks like historically they're also paying for certain technologies. So the question I would ask is like, is that like a part of their ongoing research and development? Are they always going to need to be acquiring certain technology? If so, they need to factor that into their budgeting, their overall business plan for the future. So they need to always, I guess what I'm trying to say is when they're preparing a budget, of operations, and not only operations, but just the budget for the future, they not only need to just cover certain operations, but they need to always include enough money in the budget for these ongoing assets they got to buy in technology. Otherwise, they're going to get taken over and like from their competitors. There's a risk that if they don't stay on top of that, then they're going to be overtaken by their other competitors potentially. They always got to stay on top of their game. So financing activities, payment of contingent consideration. This proceeds from short-term borrowing. So I would go look that up and see what's going on there. That's an anomaly. So that's a cash increase more than likely because they're needing. They're probably in some. They're needing cash to probably pay for this settlement potentially. They had to pull in cash to help cover this business acquisition or potentially just these other liabilities that they're having to pay. So that was an influx of cash they got from short-term borrowing. If you notice, they haven't had to have that. So that should tell you that something triggered that short-term borrowing. And so what I would be asking as you're analyzing it, was this an adverse situation that triggered their borrowing? Why did they have to borrow $1 billion? Let's see. Proceeds from long-term borrowing. Same thing here. I would be researching why they had to borrow money. More than likely, it looks like it's a combination of these various things, but mainly a few of the, like this other liability and the acquisition would be the top two. Now so the acquisition could potentially be a positive thing if that acquisition was a good acquisition that's going to add value to their company, right? So that could be potentially a good thing. Yeah, I mean, that's kind of stuff to look for, and to write about. Any questions? Any other thoughts about the group assignment? I think there would be plenty of stuff to write about as long as it's like organized and like kind of makes sense and like it's kind of flows good. It's somewhat useful to read about, and what I'm looking at is that you're kind of analyzing the things correctly. You should be fine. All right. Let's stop talking about that.